Hello, everyone. My name is Jeffrey Haynes. I'm the owner of Forward Capital Hawaii, and I'm excited to tell you all a little bit more about an alternative qualification method for conventional financing using bank statement loans. We'll get into some of the details about using bank statement loans, but before that, I do want to say a little bit about our company, Forward Capital. We're in our inaugural year, 2025. We're super excited to offer a mortgage broker service to our clients here on the island. We specialize in doing non-conventional financing, similar to bank statement loans. We have many other mortgage programs designed for the self-employed, business owners, and just anyone with a unique income situation. However, we're a full-service mortgage brokerage, and our wholesale partners that we've partnered with are able to do FHA, USDA, VA, and all other conventional programs. So if you see it advertised online, basically, we're able to help you. That includes reverse mortgages and HELOCs. So enough about that. Let's go ahead and get right into talking about bank statement loans. So the key point here is traditionally when you go to fill out a mortgage application, most of us think that they're going to use our tax returns, our most recent paychecks to qualify us, to basically justify the income needed to pay back the loan that we're going to get. So traditional income verification requires a lot of paperwork. And bank statement loans are not different in that way, just different in the type of paperwork we're going to bring. So this program itself, it's really designed for people that may show the low tax and taxable income, right? Most business owners, of course, they're going to write off as much as they can in order to pay less in taxes. And because of that, if they were going to get qualified in the traditional method, they would likely qualify for less than they would if they go for the bank statement loan. And in many circumstances, they don't qualify at all, based on the house or the property that they want to buy. It may be too expensive, and although they feel they can afford it, their income may not show it. All right, and again, we're using this program to help qualify our self-employed individuals, freelancers, gig workers, small business owners, basically anyone with income that really doesn't make it all the way to the end of your tax forms, or the tax return, I should say. So if it's inconsistent, hard to document, it could be a challenge to qualify for other programs, but that's where bank statement loans come in handy. So again, we've talked about flexible documentation requirements. So what does that mean? Traditionally, we're gonna look for a lot of the same documents. ID, we're gonna look at its core, we're gonna look at your bank statements to decide if you have the income that you need to afford the loan that you want. And what we're looking at is a consecutive period. So it has to be at least 12 months. We have programs for up to 24 months as well, but it has to be consecutive. So we look at the last 12 months of your business or the last 24 months of your business, every single bank statement, and that comes to me. We process that information and we look at all of your deposits. Now, we would love to be able to just take every single deposit that's listed on your bank statement. Sometimes we have to disclude some. And an example of that would be maybe a deposit that is well above your average deposit, right? It looks like it may not have been for your normal business operations. It may have been a one-time payment, something like that. A lot of times we do have to disclude those deposits. However, it's not a guarantee. Sometimes we're able to get waivers to count those deposits towards your income. But yeah, so 12 consecutive bank statements. We're looking at all the deposits, and actually we're going to take away any transfers from one account to another. We really just want to document the income that your business has coming in through its normal and regular predictable revenue methods. We also consider ownership of the business itself. So if it's completely yours, maybe you're a sole proprietorship or a single member LLC, and you have no partners or anything like that, then you would have 100% of the deposits, potentially qualify for review in the bank statement loan, right? So if you're 50-50 partners with someone, then basically we look at the deposits and we multiply it by your ownership percentage, which in that case would be 50%. So that it's important to provide your business documents. That's going to be something definitely that we look for. And in addition to, there's going to be a lot of just maybe even a bill of sale or receipts for some of the transactions to show exactly, basically that transaction is justified, is regular, is normal, expected, and will continue. And it's the same thing for traditional income, right? We often ask for verification of employment if someone has like a W-2 job. So it's very similar, right? We just want to be able to verify that whatever income you're showing is likely to continue. We don't want to put you in a situation where you may not be able to afford the loan that we're writing for you. The actual methodology is based on a couple of things. We look at deposits made into the account. We look at your ownership percentage in that particular business. And we look at averages, excluding any major changes, right? Any major differences or deposits that are too far above average. And different lenders have different standards for this. So one lender says, look at the average deposit, anything greater than 50% of that, do not count or exclude without justification. And justification can be different things, right? You could say, well, I just had a busy month and this is, I have the receipts to prove it. It could be, well, yeah, I sold some equipment and that was the reason why we got that big deposit. It's not likely to happen every month or every year even. So yeah, we can't really justify that. There are other ways to utilize that money potentially through a tool we call asset utilization. That's something we can get into at a later date. So again, we're going to look at all the deposits made into the account, all the deposits that look like business revenue. We're going to average those, multiply it by your ownership percentage, and then we're going to multiply it by an expense factor. And now this gets a little bit more complicated. Traditionally, the expense factor that we can use or just assume about a lot of businesses is about 50%. And we'll get into a detailed example later on. However, basically every business has expenses. We know that and we anticipate that. Your CPA can review your business bank statements, your financial documents, and help us understand your business a little bit better by providing their own estimate of your expense factor. So there's plenty of businesses that don't need 50% of their revenue to cover their expenses. If that's your business, then in order to get a lower or be able to utilize higher amounts of your income and have a lower expense factor, we just need to talk to a CPA and sometimes even an enrolled agent, either or, and they prepare a letter looking at your business, your tax returns, how you spend your money, and they'll tell us what your expense factor should be. Without that, we will have you fill out a business narrative where you talk a little bit about your business. It's usually a 1 or 2 page document. You tell us things like what you sell, what you do. You tell us if there's been any more major changes to your business in the last year, and it's pretty straightforward. But we'll use that also to assume your expense factor if in the absence of a CPA or enrolled agent's letter. So getting into the details of the loan program, a lot of times the question is this something that's competitive? Is this something that is too expensive when compared to conventional financing? And I think the answer is it depends. Right now, interest rates on bank statement products are really competitive. You can usually expect them to be anywhere from, I would say, 1 to 2, sometimes as high as 3%, depending on the loan amount, above what your government loan programs are. So if we see For example, VA loans being issued at 5.5%. VA traditionally has like the lowest rates when it comes to loan programs. We would expect our bank statements loans to start around 6.5%, right? Maybe 1% higher, depending on the lender. Could go much higher. Different lenders have different bank statement programs. For example, one of our partner lenders that we work with has 4 different programs for bank statement qualifications. And so depending on that particular program, and also, how that program is structured, you may see lower or higher interest rates, even at the same lender, when they're offering different products. And that's not abnormal. Interest rates are competitive, especially since a lot of these loan programs require some equity. They require, 10% down, 15% down, sometimes as high as 20 or 25% down. Really just depends on what you're looking at. They can be used for primary residence, and in a lot of circumstances, they can be used for a secondary residence or an investment property. For some of our first-time home buyers, it sounds like the justification is that the lender wants to know that you can manage a mortgage. And so they want, for a first-time home buyer, they will not use this program for an investment property. They want to know you're in a primary residence first, you're able to pay that consistently, show a good history of payment before they'll let you use this program for an investment property. Everyone else, if you're not a first-time home buyer, or if you are a first-time home buyer and you're buying it as a primary residence, bank statement loans are definitely an option to consider. Every loan program is slightly different, so limits can be different. I have seen one of our partners go up to $5 million total purchase price, total loan for one of their programs. And I've seen some lenders will actually cap it based on your credit score. So what you'll see is if you have a lower qualifying score, maybe like 640 or 680, your cap could be up to 1.5 million. And if you bump it up to 700 or even 720, then your cap could be closer to 2 million. It just depends. Every borrower is unique. Their situation is unique, deserves that special attention, and the properties are also going to be unique as well. So why choose Forward Capital when you're considering a bank statement loan or really any other loan? So first thing to consider is we have definitely a customer service first focus, right? So our whole business is focused on referrals, building relationships, people that are connected to us by other agents or actually other lending partners. Just because we have the ability to spend that one-on-one time going through the business, going through the bank statements, going through your goals and how this fits in your plan. We're not one of the big corporate lenders where you're going to be working with 3, 4, 5 different people. You have one person managing your entire loan process. And of course, they're going to communicate with underwriting. They're going to communicate with account executives and whoever they need to in order to facilitate the process. But, they're going to be your main point of contact. Everything will funnel through them, including some of the communications from the escrow or title team if they're involved. So that's something that not everyone can guarantee, and that's something that we can confidently guarantee. Our expertise in real estate and finance just ensures that you're going to know that you're finding the best option for you at that time. As far as shopping our rates are, I would say, even more than competitive. As a smaller shop, we don't have the overhead that many organizations do. We have a very, very efficient and modern underwriting process where we can do a lot of the front-end work on your particular application early in the process. So that way, when you're under contract, and there are a lot more things to consider as far as purchasing a home or even refinancing, once that process is rolling, there's things coming in left and right. Lender conditions, title, maybe home inspections if you're purchasing. It's a lot to balance. So what we do is to focus on the front end, to do as much work as we can to help alleviate the pressure during the refi period or even during the purchase contract period. And again, our loan options, we currently work with about 3 or 4 core lenders. Basically, we found that as far as getting our clients the most competitive rates with the most flexible programs. These four really cover quite a bit. We have 2 small credit unions that we work with on the mainland to kind of offer solutions in more creative situations. But we have access to another 20 or more lenders that we can compare pricing to basically anytime we want to. And if it makes sense for us to start a relationship with a new lender in order to get our client the best deal at the time, we will happily do that. So let's just look at this case study real quick. This is a friend of ours that wanted to purchase a home. And they thought just because the way they structure their business, their income wouldn't justify the purchase price that they wanted. So what we were looking at here is just how much could we qualify them for as far as a monthly income amount based on these deposits. And so they sent over through our loan portal, they sent over 12 bank statements in PDF form. So it couldn't be like it wasn't screenshots of their, bank statement or anything like that. It was a true PDF from the bank. And we looked at all the deposits, and you can see them listed here, right? Ranging anywhere from $8,700 on the lower end to a little over $14,000 in September. Their business is doing really well. It looks like pretty consistent income. It kind of jumps up a few months, but depending on the business cycle, that's really normal. So looking at this, basically we came out to an average monthly income. If we add up all 12 months divided by 12, we came up with average monthly income of a little over $10,000. And we talked about expense factor in the past. The expense factor for this was actually shown by a CPA to be about 30%. So we were able to basically take away 30% of that average monthly income and qualify them based on this number here, $7,269. Now, in Hawaii, with rates as they are, that still gives you a lot of options. Single family homes, condos, townhouses, including taxes, including insurance, including all the things that you'd normally pay for when you buy a home. So this was great, right? This is their qualified monthly income. This is the starting point. Now, after we calculate this $7,000 number, that's when we take into consideration any existing debt that our borrower or applicant has. So this could be credit cards, student loans, any debt that shows up on your credit report. And what we want to do here is we don't want your debt, when compared to your income, to be more than 50% of your income. So if we add your monthly housing payment with principal, interest, taxes, and insurance, and HOA or maintenance fee, if that applies, we add that payment to all the debt you got. We want that to be equal to or less than 50%, right, of your total income. So this is a lot of times a sticking point, right? We would love to be able to just take that qualified monthly income number and apply that to the mortgage payment, right? But you got to eat, you've got other expenses, and lenders know that. So what they want is to make sure that we're not utilizing more than 50% of that number. And different loan programs have different amounts. A lot of our government-backed products, their DTI, as we call it, debt to income ratio, is a lot lower. They want to see even 40% or less. Okay, just some finer details. Basically, applying for a program like this starts at our website. Link is provided. And the main thing you want to do here is prepare in advance those 12 months of business bank statements. If you're going to go the 24-month route, that's great. Let's prepare all 24 months in advance. That way we can cut straight to it to see what that starting income number is. You can use at least two, or you can use up to 2 companies or 2 accounts to qualify for these programs. So if you have multiple business accounts, regardless of what they're structured for, you can use 2 accounts to count that towards your income numbers. So it sounds like a lot. It's purchasing a home, refinancing, getting these loans. Yes, it can be a process, but that's why you work with someone that is available online, on the phone, via text to support you. So if you have questions on this, just contact us for any sort of consultation. We can even just look at a couple bank statements and walk through, an estimate or like step by step how we would qualify you to give you an idea. If possible, you don't want to share too much information up front. That's okay. Our goal here is to educate, show the option, and if it's a great fit, then we'll help you move forward to the closing table. If it's not a great fit, we'll help you find other options. We're happy to spend the time doing that. If you have any questions on the bank statement loan program or about financing and real estate, period, you can call us anytime. Information is provided here. We thank you, everyone. We'll actually stop the recording now and get into questions. And great. Thank you so much.